Okay, in this case, you're trying to value the synergy in a merger of a media and an entertainment company. You're provided with the following information on the two companies. Paris Media is a movie company that expects to generate $50 million in after tax operating income next year. So EBIT into 1 minus T next year on revenues of $1 billion. So whenever you have EBIT into 1 minus T as an input in the question, you should automatically be thinking about FCFF based valuation. The company has no debt, that simplifies things, and it has 50 million shares trading at $10 a share. So the combined market value, um, the market value of equity for this firm will be 50 million shares into 10, so $500 million. AVAX is a software company that specializes in animation software. The firm expects to generate 10 million in after-tax operating income next year on revenues of 500 million. The company has no debt and 15 million shares trading at $10 a share. So here we have the market values of both the companies. 500 million for the for the company Paris, and AVAX has a market value of equity of 150. And since there is no debt in either of the companies, therefore, this is also the firm value as well. Both firms are in stable growth, growing at 4%, cost of equity 9%. You can assume that both firms are correctly priced currently. Now, this line is very important, right? So, as you discussed in class as well, this gives you and an indication that the market value of the firm is equal to the intrinsic or the fair value of the firm. Therefore, you can use that in the FCFF based valuation equation as to find either the FCFF for next year or the weighted average cost of capital or the growth rate. So you will have the left hand side given and you can use that to find any of the missing inputs on the right hand side. Right. So moving on, if the combined firm will be able to generate the same earnings both next year and in perpetuity, okay, the same earnings, so basically the same return on equity or the same return on capital, but with half of the reinvestment that is made by the individual firms now. So as we know that organic growth is achieved by reinvestment or reinvesting some portion of the EBIT into 1 minus T, we call this rate the reinvestment rate. So now what is going to happen is with that when you combine the two firms, they will be able to generate the same growth rate of 4%, but only with an investment of half the amount that was necessary earlier, right? So estimate the value of the synergy in this transaction. So this is the only source of synergy, which basically means that the combined free cash flow to the firm is going to be greater because again, lesser reinvestment need is going to be there with when you combine the two companies. So the FCFF is going to go up. The WACC is going to remain the same. The growth rate is going to remain the same. Okay, let's proceed to the calculation. So one very important um, thing to remember in this question is that generally, when we're trying to find the um, reinvestment rate, as it is not given here, we are given the EBIT into 1 minus T. So in order to calculate what the free cash flow to the firm is going to be, we would need the reinvestment rate, right? And we generally calculate reinvestment rate by G divided by return on capital. But here, although the growth is given, but the return on capital is not given. So that route cannot be taken. So we have to use some other source of information which is there, and that information is right here. So we are going to use the current firm value which is given by the market value of the firm, both in the case of Paris and AVAX, and we're going to use that firm value to find what the current forecasted free cash flow to the firm is for the next year. That is being done right um, here. Right. So this is basically the formula that we are using to find the FCFF. Right. So what we are doing here is that on the left hand side we have $500 million, and you're multiplying WAC minus G with it when you would be able to calculate the free cash flow to the firm next year for both the companies. So now Paris, as you can see, has a free cash flow to the firm of $25 million, while AVAX has a free cash flow to the firm of 7.5. Now you've got the EBIT which was given, and now you've just calculated the free cash flow to the firm. And by using these two numbers, you can find what the reinvestment rate implicit in this here, in these two numbers is. So if you got 50 million in EBIT into 1 minus T and you only had 25 million in free cash flow to the firm, this automatically means that you are reinvesting 25%, $25 million of this $50 million back to the company. So 50% is the reinvestment rate. Similarly, out of the 10 million, you're left with a free cash flow to the firm of 7.5 million, which means 25% is being reinvested. So you've got this reinvestment rate. Now this um, part says that the combined company will be able to generate the same growth, but with only half the reinvestment rate. So the individual companies had 50% and 25% respectively as their reinvestment rates. The new reinvestment rates are going to be lesser by half, right? So zero point 0.5, zero point 0.5, this can be expanded a bit. Yeah, 12.5%, right? So with the help of this new reinvestment rate, we can find the new free cash flow to the firm, which is basically the same EBIT into 1 minus T multiplied by 1 minus the new reinvestment rate, which gives you an increase in free cash flow to the firm, both for Parex and AVAX. Now, these two added up will be the combined um, free cash flows to the firm, and you can either add them up together and discount them as one entity, or you can do this individually. So Paris is now worth $750 million when it's part of this combined company, and AVAX is now worth 175 million. Earlier it was worth 150, while Paris was worth $500 million. So the value of synergy in this merger is 250 arising from Paris and 25 million arising from the AVAX. So 275 million is the value of synergy in this merger. The last part only wants that if Paris had paid $250 million to acquire AVAX, what would be the value of equity? So this is very simple. So the for a company which was worth $150 million, Paris paid 250, which means that they paid a premium of $100 million. Now that premium, where does that premium come from? It comes from the $275 million worth of synergy. So 100 million out of this 275 million was given to the shareholders of AVAX. So what is Paris then left with? They're left with 175 million extra, which we then add to the value of the existing company. 500 plus 175 gives you the new value of equity for the combined company. When you divide it by the number of existing shares of Paris, you're left with a share price of $13.5, which is what the requirement of B part is. All right, that I hope was understandable. Thank you.